Good afternoon. It's Jeff Christian of CPM Group. It's about 2:25 in the afternoon on Tuesday, the 12th of December here in New York. I want to talk about inflation. The November CPI figures were released this morning, and they've had a little bit of an effect on gold and silver prices. And more than that, I want to talk, about gold and silver prices over the last couple of weeks. There's been something of a whirlwind in the prices. Gold prices have been trading at record levels really for the last 4 years, but incrementally higher. And we've seen much higher prices this year than we saw in the second half of 2022, where the average price of gold in 2022 was probably $1,804. This year, it's probably going to be close to $1,950, maybe a little bit higher by the end of December. Over the last couple of weeks, since the beginning of December, we've seen very volatile prices in gold and silver, as well as other assets too. We've already talked about the fact that on Sunday night, December 3rd, when trading resumed on COMEX, about 18 minutes after trading resumed, you saw a large spike up in gold and silver prices, which also coincided with a large spike up in petroleum and platinum and some other commodities, and a spike down in the S&P equity futures, index futures. And then that was who it was. Gold rose $62.60 from Friday's close to a peak, which was a record of $2,154.30 in 20 minutes on Sunday night, December 3rd. Over the course of trading during the daytime in New York on Monday, December 4th, gold fell $113.90. So it gave up 180% of the gain that it had in that 20-minute period on Sunday night. Traded between, say, 2030 and 2060 for most of last week. Monday, it fell sharply. It got down to as low as $1,991.20. That was pretty much in response to a very strong jobs report on the previous Friday, the 7th of December. And it's sort of trading just below 2,000 now. It did get up to 2012 in early trading on Tuesday today, but then it came back off after the inflation figures were off. Silver prices shot up to $26.34 on that Sunday night, December 3rd. That was the highest intraday high for silver since May 5th. Quite a bit off from its previous records. But, as these charts show, gold has been making new records, 2000, 2021, 2022, 2023. Silver has risen sharply from prices that were in effect prior to 2020, second half of 2020, but they're down quite a bit from their record levels of close to $50 in 2011 and in 1980. They fell on Monday trading. They got down to $24.79 that day, and then yesterday, they dropped as low as $23.02. They're trading just above $23 today as I speak. So that Sunday night event, as I said, it was across assets, indicative of the fact that it was pretty much exogenous factors, not factors specific to gold or silver, that led to that price spike and to the subsequent decline. The price spike was partly triggered by technical computer-generated buy orders that kicked in when trading resumed. And it was also something of a response to the idea that, Federal Chairman Jerome Powell had said on Friday that the market was probably over-anticipating cuts in interest rates, that the markets were ahead of the economic realities, that interest rate cuts will only come when we see a significant widespread economic weakness emerging, risking lower employment and recessionary conditions, and that may not occur until March or May or who knows when. I mean, there are people, gold promoters and others, who have been talking about how we're going to have a recession in 2021, 2022, 2023. It's impossible to say when a recession might set in, because if you could tell that, you could take steps to try to avoid it or at least ameliorate it. The sell-off on Monday, the 11th of December, is, as I said, a reflection of a response to the good, strong jobs report that was released last Friday, which sort of reinforces the idea that the Fed isn't going to probably be cutting interest rates anytime soon. So let's talk a little bit about inflation. The data for November came out. October had seen flat prices in zero increase in the overall consumer price index from September levels. November saw 0.1% on a month-to-month basis. We always like to look at it on a year-over-year basis. On a all items basis, which includes food and energy, you saw inflation tick a little bit lower to about 3.1%. On a core inflation level, which takes out the more volatile food and energy, it was basically flat at a 4% increase. You have a situation that you've had now for most of this year where the core inflation actually is rising more rapidly than the headline inflation, which includes the volatile food and energy. And that's because food and energy are more volatile. And whereas they had been volatile to the upside in 2021, 2022, for most of this year, they have been volatile to the downside, specifically energy. And if you look at the data here, what you'll find is that the big decline in November prices was in the energy sector. Natural gas, the delivery prices of the service of delivering that natural gas, and then also petroleum products. They were all declining sharply. And those were the biggest declines that we saw. Food was up a little bit, and then you had the big increase in the core was in transportation services costs. Other core inflation factors were relatively benign. So you're seeing those pockets of service costs still strong and inflationary, but goods costs, both within the food, energy, and non-food and energy sectors, have been less inflationary. They're not deflationary, they're disinflationary. They're coming down. So it's a very mixed picture on the inflation basis. I want to show you one more chart because the Bureau of Labor Statistics, which compiles the data for the Consumer Price Index, when they come out with their monthly reports, they show 12 months worth of data. We like to take a longer term perspective. And this is the CPI figure really going back, I think, to 1990. And you can see in that period going into the 1991 recession, we had a little spike up in inflation, but it was running around 5%. It came down and it was basically flat, around 2.5%, 3%. Then it went below that. We had a deflationary period, if you will, not really deflation as economists think of it, a couple periods of contracting prices during the Great Recession and the global financial crisis. Came back up. It was trading between, say, 1% and 2.5% for most of that time, CPI. It spiked higher when we came out of the lockdown and post-COVID period in 2021 into 2022. Fed started raising interest rates in early 2022, and inflation has come down. So when the Fed and other mainstream economists talk about how that rise in inflation, which got up to about 8.2%, I believe, was a transitory spike in inflation and a post-COVID, economic lockdown recovery period. This is what they meant. Spiked up and it spiked down. You can see there are inflationary and deflationary pressures at work in the global economy and in the U.S. economy, but there's no reason that you can see right now to either expect hyperinflation or deflation in the next several years. Most central bankers and CPM Group and other mainstream economists have been worried about long-term deflationary pressures because of excess labor, excess manufacturing capacity, excess retail capacity, excess commercial real estate. But those are long-term concerns, and they have been sort of pushed aside by developments since 2020. So this is the longer-term view of inflation. We're sort of getting back down to that period, to that range of inflation that was persistent from, say, 1991, 1992, up until 2021, with the exception of those recessionary periods of time. So that all leads to, where do we go from here? Well, today and tomorrow, the Federal Reserve's Open Market Committee is meeting, and it will make a statement tomorrow, and it will release data on what the Fed FOMC members think might happen in the economy and with interest rates. So I think the markets will remain pretty jittery for the next 24 hours, waiting for that to develop and to see what exactly the FOMC says. I think the majority or the consensus view is probably that the Fed will maintain interest rates on an unchanged basis and not increase rates because of recent strong economic indicators, but also not decrease rates. And then they will make a statement to the fact that you're looking at a situation where you really are in new economic terrain, and there's a heightened uncertainty as to how everything works together. But they will maintain their vigilance, watching every data point that comes out to see if they should be more worried about inflation or unemployment. And I think that that's going to maintain itself for the next 24 hours. When we get to Wednesday afternoon, we will have the Fed announcement behind us. And then I think the markets will begin looking at the end of the year, wrapping things up. There'll be book squaring and profit taking from institutional investors, which could weigh on some markets, including gold and silver, in the last 2 weeks of the year. And then when we get into 2024, people will be focusing on the risks inherent globally in the U.S. election, other risks that are coming up, anti-democratic moves around the world, Russia's invasion of Ukraine, the Israeli-Hamas war, developments between China and Taiwan. There's a host of political issues as well as economic issues. And as we've said in past videos, we do think that what you'll see is a lot of investors will say, I think I still want to maintain an above average weighting of my wealth stored in gold and silver because of all of these political and economic risks. I don't think that 2024 is going to be a particularly pleasant year on a global basis. And in that kind of environment, we think that investors will probably step up their gold and silver purchases sufficiently to drive gold and silver prices up rather dramatically to new record levels for gold and getting closer to record annual average prices for silver over the course of 2024. A lot of that backloaded into the second half of the year and October leading up to the first week of November. That's all I have for now. Take care of yourself. Take care of those around you. Take care of those that aren't around you. Try to do something good for the world because, as I said, I think we're going into a very turbulent time in 2024 and probably also 2025.